in the red. Yesterday, it dropped to less than 47,000, persisting there now. And then also when we look at South Africa, it's in the red, 0.15%. When we look at other parts of Africa, looking at Egypt at this time, it's up at 0.88%, and Kenya closed yesterday's trading in the red, 0.53%. In the Middle East, we know that two major markets there are closed on Fridays. The only ones who are open are the UAE, and they are trading positive at intraday, while others closed yesterday negative. And so it's at intraday, it's a positive trading market for the Middle East. That's Abu Dhabi and Dubai. Moving on now, let's go to Asia and see what's going on in the Asian markets. And shares in Asia Pacific fell on Friday ahead of the monthly U.S. jobs report, which is likely to guide the Federal Reserve's monetary decision in December. We see the numbers there. Nikkei 225 is down, and as well as Shanghai Composite, and then the Hang Seng Index also down more than 1.5%. So payrolls are expected to increase to 270,000 in September, and unemployment is predicted to be steady at 3.7%, according to a survey. And in Japan, it fell. The market fell 0.71% to 27,116.11, and Topix Index slipped 0.82%. In Australia, the S&P AX 200 fell 0.8%, and South Korea's Kospi lost 0.22%, while Kosdaq dropped 1.07%. MSCI's Broadex Index of Asia Pacific shares outside Japan fell 1.29%. Remember that mainland China is still closed for a holiday. And in the United States, stock futures were mostly weak on Friday morning as investors looked ahead to September's jobs report for further clues into the Federal Reserve's tightening campaign. And looking at the numbers there, the Dow Jones in the green, 0.18%, S&P 500 also in the green, while Nasdaq is the only one in the red. Advanced Micro Devices stock fell in overnight trading after the chip maker warned its third quarter revenue would be lower than anticipated, and more major averages closed lower during Thursday trading, but on pace to cap their best week since the 24th of June. All major S&P sectors finished the session in negative territory, with the exception of energy. The sector rose 1.8% as oil prices gained, and it's on a pace to close out the week 14.7% higher. So now let's go to Europe now, see what's going on in Berlin. And we see that after a grueling period of disruption because of vital components missing the tide, it seems to be turning on the German auto market. Sales last month rose again for the first time in months. We have Chris Kober joining us now to give us the details of this. Chris, good afternoon. Thank God it's Friday. And what are the indicators that the downward trend is really reversing at this time, Chris?
It indeed is the question if we are seeing a reversal of the trend. Experts are saying that it is not what this is. Yes, almost 225,000 new cars hit German roads last month, the Federal Transport Authority says, which is a 14% increase on a year earlier. But the jump does reflect an extremely weak September last year and a delivery backlog from the previous months, the Car Importers Federation says. So the figures represent producers being able to successfully deal with the backlog that has been there due to a global shortage of essential parts, mainly semiconductors. And these problems appear to be easing. Auto manufacturers have for months had to deal with the supply issues, with shortages of key components leading to intermittent production stops and a slump in sales. Now factories, again, are receiving component shipments, and they are able to address the orders which they have. Nevertheless, the Car Importers Federation says sales figures after 3 quarters this year are sobering. For the first time ever, sales after 9 months are below 9 million units. Now, on a positive note, sales of fully electric vehicles continued their upward trend, rising by 32% year on year. In September, almost every 5th car sold was a fully electric one. 13% were plug-in hybrids, and average CO2 output of all new cars on German roads sank by around 4.5% thanks to these sales.
Well, on the other hand, there's also been a lot of conversation about battery-powered vehicles, the EVC. That has been not just in Germany, you know. How is that? Is the sales in that picking up also?
That's mainly because of the overall economic outlook. Experts believe that car demand is likely to shrink in the coming months as Germany braces for a recession and inflation stands at historic highs. Consumer sentiment has reached a low point and major purchases are being postponed. That's why we should not expect a sweeping market recovery in the coming year, experts say. And car makers receiving the semiconductors they for months have been missing could be another indicator for trouble ahead, as production facilities for these parts can only be expanded slowly. Yet the fact that they are available on the market could point to less demand from other industries, which overall wouldn't be a good sign as well. So experts are saying despite the positive figures for September, the German auto market could be tipping from supply weakness on the producer side to demand weakness on the part of consumers.
And how's the market? We see the stocks, the market stocks for the cars. How are they faring?
Not a lot of activity among investors this morning ahead of the most recent jobs market report in the United States. And this report is of even bigger significance than it usually is, as it'll play a major role in the Federal Reserve's further rate hike plans. Analysts expect the monthly report to show 250,000 posts were created in September, which would be the weakest since late 2020, but still a healthy figure, suggesting a strong labor market. So ahead of what many believe will be a pivotal report, everybody's pretty cautious. Germany's blue chips index DAX declining around 0.4% this morning.
All right, Chris, thank you so much. It's been a long week. Thanks for the updates. Let's look at other markets now. Going to oil market, prices rose on Friday and was headed for a second consecutive weekly gain, supported by OPEC Plus' decision to make its largest supply cut since 2020. Despite concerns about recession and rising interest rates, the cuts from OPEC and its allies, of course, which Russia is a part of, comes ahead of a EU embargo on Russian oil and will squeeze supply in an already tight market. Brent crude was up 99 cents to $95.41 a barrel. U.S. West Texas Intermediate crude also gained 99 cents in its case to $89.44 a barrel. Both benchmarks were heading for a second weekly gain, with that of Brent approaching 8% this week. The global benchmark is still down sharply after coming close to its all-time high of $147 a barrel in March after Russia invaded Ukraine. In the metals market, gold prices were stuck in a tight range on Friday as investors braced for that jobs report from the United States, which could influence the Federal Reserve's rate hike trajectory. However, bullion was still on the track for its best week since March, helped by retreats in the dollar and U.S. Treasury yields. Spot gold was about flat at $1,710.30 per ounce, and prices have risen about 3.3% so far this week. US gold futures were down 0.2% at $1,718.10. The payrolls report is out. We just got that information, and of course, we'll drill down and see if it met the expectation of 250,000 jobs created last month, September. But of course, trust us here on the business desk here on Channels Television. Subsequently, we will give you the details of that jobs reports. Let's come to Nigeria now. One of the biggest stories today is that the 2023 budget has been presented by the President Muhammadu Buhari. It stands at 20.15 trillion naira. Even before now, when the proposal was at about 19 trillion naira, we saw that the deficit was more than 11 trillion naira, hinting at another set of borrowing. So now we want to drill down on this and see some of the possible ways of funding this. And we have joining us for that conversation, Mr. Ayodeji Ebo, the Managing Director of Optimus by Afrinvest, joining us for that conversation. Good afternoon, Mr. Ebo. Thank you so much for joining us this afternoon.
Yeah, good afternoon, and thanks for having me.
I wonder if you followed the presentation by the President, and what are your initial thoughts on you know, the presentation and the numbers that came out of that presentation?
Okay, thanks. And based on the text that was read, we've not seen the main document. And the budget has been called the budget of consolidation and transition. We know there's a new government taking over from next year. And the budget size about 19.78 trillion, which is massive. That's almost about 15% above the 2022 approved budget. Beyond that, part of what stood out was the 3.6 trillion naira budget for subsidy. And when you compare that, you would compare that to about 3.9 trillion naira that is being budgeted for capital expenditure. You would see that just about 19%. The amount budgeted for capital expenditure is lower than what was even budgeted last year, which shows that we shouldn't expect much impact from that, because the capital expenditure element is also a major part that benefits a larger part of the populace. Beyond that, when you look at the deficit, the budget deficit has also jumped up from this year's approved deficit from about 6 trillion to about 10 trillion. The new borrowings has been estimated about 8 trillion. So that's also very massive. And what would be coming to the mind is how do we fund? How do we get 8 trillion? And this is just budgeted. It means that when you look at it based on past revenue, we're projecting that based on this year, if you analyze based on budget performance, government will make about 5 trillion. And based on the projected revenue, about 9 trillion. So you would try to see that deficit would also cross about 10 trillion, which is also a major concern.
Mr. Ebo, so obviously I think you still have that proposed budget that the President had even before today, because at today's presentation, it was reversed from 19 trillion to 20.5 trillion. But let's look at some of those details. And one of it is like oil benchmark has been placed at $70 a barrel. Daily oil production, I think that's what really catches attention, has been placed at 1.69 million. Meanwhile, at this moment, our quota is about 1.8 million. But as at August, we're not even able to meet up with 1 million barrels a day. So it now begs the question, is this our reality, this 1.69 million barrels a day? If our revenue or our budget is based on the revenue from oil, we are not able to meet 1 million barrel, and yet the budget is proposing 1.69. What's the reality in all of that?
Yeah, so that's why, like I mentioned earlier, that the projection would be above the 10 trillion being projected as the budget deficit, because we also look at the reality: $73 per barrel oil benchmark, and our production is still far from where it is. So it's really a major call for concern, and something that I think is also good to notice that budget deficit also increased to about budget servicing increased to about 6.3 trillion. So what we'll typically see from the 4 trillion that was projected in 2022 is that the efficiency of the budget will continue to reduce as we continue to borrow more, because most of the actual funding that we would get, or actual revenue, would be trailing the amounts we use to service debt, which is also a major concern. So I agree with you. It's not, when you look at the numbers, it's not realistic.
It will be interesting also to look at the exchange rates, which has been placed at 435 naira for $1, and we know the reality at this time. But I mean, it's time for a break now, Mr. Ebo, and I know we might even reach out to you subsequently on Business Morning to have this conversation. But thank you for answering us at such short notice, joining us on the program
pleasure.
after that budget presentation. Let's take a break now. When we come back from that break, another conversation is on the other side. And it's not so different from what we see. Debt distress in some countries in Africa, it's a source of worry. Join us for that conversation on Business Incorporated. Yeah, welcome back. You're still watching Business Incorporated here on Channels Television. The World Bank has said that 8 countries in Sub-Saharan Africa are in debt distress already, and 14 at high risk of joining them. The bank said the countries are part of 38 countries eligible for the International Development Association, that's the IDA loans. Countries in Sub-Saharan Africa include Nigeria, yours truly, Angola, Kenya, South Africa, Ghana, Chad, Ethiopia, and others. What does this mean for these countries? Can this be averted? Can they escape being in debt distress? So we'll have Matt Kindiga joining us now. He's practice lead, Sub-Saharan Africa for Front of View. Hi, Matt. Good afternoon. Which countries, when you saw these stories, which of the countries are you most worried about, thinking about public debts and debt distress?
Yeah, hi. Thanks for having me on the show today. So this is something that we're watching very closely here at Front of View, and this is because we have seen very significant fiscal pressures emerge since even before the COVID pandemic, and we're seeing a lot of fiscal vulnerabilities being really pronounced by the COVID pandemic and the war in Ukraine in terms of the countries that we're most worried about. So it's worth remembering that Zambia, Zimbabwe, and Mozambique are already in default, and these countries face very extreme fiscal pressures and chronic fiscal pressures. But the countries that are the most at risk in terms of entering distress or facing more fiscal distress are Ghana, which has endured a number of credit rating downgrades over the last couple of months, and this has resulted in its debt servicing costs rise significantly, not least because its currency has depreciated. Kenya, I'm also quite worried about Kenya because the country's debt profile has deteriorated quite steadily over the last couple of years, and we expect to see a bit of a fiscal crunch emerge over the next 3 to 6 months. So this will pose a very significant challenge for the new Ruto administration. And Ethiopia, as you mentioned in your introduction, also a country we're worried about because of the drain on public finances caused by the civil war, which has been going on for more than a year now. So certainly a number of countries that we're quite worried about. To a lesser extent, South Africa and Nigeria are 2 countries as well that are facing fiscal pressures, but I would say Kenya, Ghana, and Ethiopia are the most worrying at the moment.
I'm sure a lot of our viewers just heave a sigh of relief that, oh, I thought Nigeria was going to be in that very red list, even though, of course, Nigeria does have its own challenges dealing with debt, especially with the budget we just talked about, increases debt servicing and the risk of borrowing. But so do we expect a wave of defaults across maybe among some of these countries you've mentioned or across Africa?
Yeah, so I mean, it's interesting you mentioned Nigeria. So Nigeria has two things in its favor, which means it will most likely avoid a default. One is that public debt is actually quite low as a percentage of GDP compared to other countries in Africa, but also it will benefit from very high global oil prices, which we expect here at Frontier View to continue to rise over the next quarter. So certainly that will provide a bit of a lifeline. In terms of the other countries that we've talked about, so the good news is that we think defaults are unlikely, at least before the end of this year or the beginning of next year. And this is because we think that the countries that are most at risk, especially Ghana and to an extent Kenya, will, if necessary, if they face a real squeeze, will end up getting an IMF support. They'll also get some form of debt forgiveness. We do expect to see international lenders extending credit terms, for example. But we're also going to see certain countries that would normally or would otherwise face quite significant debt pressures, such as South Africa and Angola, benefiting from very high commodity prices. South Africa's public finances have received a real lifeline from high global iron ore and coal prices. The government benefits from taxing these industries, so it has been able to boost its revenue. And also Angola's fiscal position has turned around quite significantly as a result of very high oil prices. It's worth remembering that only last year it came within about 2 weeks of defaulting on its debt, and it now is in a much better fiscal position. But the longer we look out to the future, the more likely there is a risk of default. For example, Ghana, if it doesn't get an IMF deal over the next few months, could actually default on its loans.
Wow. So is there a way of escape? What should governments be doing now to try to deal with this debt pressure?
Yeah, so I think this is the thing we're really going to be focusing on a lot here at Frontier View over the next couple of months. Is I think a lot of governments are going to have to face the music, so to speak. There's going to be effectively much broader austerity measures across the region. So we've had a number of elections across the region. Well, Nigeria has an election coming up in 2023. Kenya's just had an election. Zimbabwe has an election next year. So especially, the countries that have passed elections will probably see much more significant austerity measures, reductions in spending, limits on capital investment. We're also going to see governments become a lot more aggressive in tax collection and trying to expand the tax base. So certainly more taxes, less spending growth. We're also going to see things like civil service wage increases, which for many governments are a significant burden on their budget, will probably begin to deteriorate somewhat. So we're going to see a bit of pressure on civil service wages. But we're also going to see governments increasingly turn towards international organizations like the IMF. So certainly we would see Kenya probably a candidate for more IMF support, for example. And in Ethiopia's case, the civil war is probably going to be one reason. Well, the fiscal pressures the government is facing is one of the reasons why we think the government will try to find an end to the civil war, for example. So there will certainly be a number of changes that we're going to see from a fiscal perspective. So governments, in order to avoid default.
All right, smart. Well, obviously, those assistance from the international community also comes with some condition. I know Egypt, for instance, is dealing with a request to devalue its currency, So, but anyway, as you said, as you're watching in front of you, we're also watching here in channel. Thank you so much, Matt, and enjoy your weekend.
Thank you, you as well.
So let's see what's happening in Kenya. Kenya was there when Matt was talking about, well, their Airways has dropped 3 places in the latest global ranking of airlines, trailing its regional rival, Ethiopian Airlines, which recorded a significant jump to fly within the top 30 carriers in the world. Skytrack World Airline Awards, which rates the world's best carriers, placed KQ in position 81 in this year's ranking, down from 79th in last year's report. Ethiopian Airlines, which rose 11 places to position 26, emerged as Africa's best carrier, with South African Airways and Air Maroc coming in at position 66 and 79, respectively, to stay within the top 100 carriers globally. In Zambia, the tourism industry offers many opportunities to invest in the country's local communities, generate economic activity, and create employment opportunities for women and the young people. And that is why the Zambia Tourism Authority announced that there would be no visa requirement for United Kingdom, United States of America, Canada, Norway, Australia, China, South Korea, Gulf States, and the European Union. In 2019, Zambia approved its Tourism Master Plan 2018 to 2038, a 20-year practical development strategy to enhance the economic contribution of the tourism sector to the Southern African nation's economy. Tourism is the country's fastest growing economic sector, contributing $1.8 billion in 2021. That's it for the program today and for the week. Thank you so much for being a part of this 5-day journey. We'll start off again on Monday. God's grace, I'm Mini John McQuarrie. Enjoy your weekend. Remember, business will be back tomorrow, 7 p.m. Capital Market. And Ladi will be here to give you a summary of what has happened in the markets all through the week. That will be Capital Market, 7 p.m. tomorrow. I'm Mini John McQuarrie. Have a great weekend.